I'm Sev Meneshian, certified financial planner with Pro Exam Tutors, and going to be talking to you today about the Rabbi Trust. So if you like the video, make sure you like it. If you want to subscribe to the channel so you get updates on videos and courses and so on, just feel free to do that as well. So let's get to our Rabbi Trust discussion, because this is a topic likely that will be tested on the CFP board exam, and it's an area that confuses many candidates, but hopefully we're going to clarify a number of things on the Rabbi Trust. Now, first of all, with the Rabbi Trust, what's the big picture here, or I guess the big idea behind the Rabbi Trust? Why is it so important? Well, look at it this way. This is a non-qualified deferred compensation plan. And what comes along with the territory with non-qualified deferred comp plans is that a lot of times it's going to be just merely a promise. Like, hey, manager, if you come along and you retire with us, we'll promise to give you a, I don't know, $1 million bonus when you retire or something. And that sounds great, but the executive says, well, what if I'm not around for 20 years? What if it's 19 years and 364 days and you guys just fire me on that last possible day and I don't get a benefit, or there's a change in management? I'm kind of left out in the cold, right? So I need some sort of guarantee in a sense that I'm going to get that $1 million or whatever the company has promised me. So what we set up is a Rabbi Trust, in that we have one of the beneficiaries of the trust, and there will be at least two beneficiaries of this trust, one the executive, and the other would be another party called the creditors of the company. And we'll get into that in a second. But fundamentally, what this Rabbi Trust is, it is an unfunded trust. Okay. And generally speaking, we have two types of plans. When we're talking about non-qualified deferred comp, we're going to either have funded plans or we're going to have unfunded plans. And even though we are going to be, as the employer, putting money into a trust for the ultimate benefit of the executive, this is still an informally funded, unfunded plan. But bottom line, it's an unfunded plan or an unfunded trust, but it is informally funded. And I'll explain what that means in just a second. Okay, so non-qualified deferred comp plan, this is, we don't have to play by the rules really of ERISA. We can certainly discriminate. If I only want this to go to the executive team and not the sales team, we can certainly do that as an employer. We can totally discriminate, not a problem. As far as the nuts and bolts are concerned, this is an irrevocable trust. It's set up by the employer, and there's a promise that's being made. And what we're going to do as the employer, so you, the employee, can see what we're doing, is we're actually going to fund this trust year after year, or whenever it's called for. But what the trust is protecting the employee or the executive from is a couple of things. Number one, if we have a change in management or a change in control, right? We have new management comes in, they say, well, who's this executive? We don't want to pay this guy. Forget that. You're not going to get this benefit. So it's going to protect against a change of heart, change of management, or a change of heart by the management. Again, who is this guy? We don't want to pay him anymore or whatever. And so as soon as that happens, if there is a change of management or a change of heart by management, then that trust then pays out that benefit to the executive. Okay, so you can see now the executive has some assurance that he or she is going to be compensated. But what makes the Rabbi Trust very convenient for the executive and for the employer, and from an IRS standpoint, is that the employee benefit is not protected if the employer becomes insolvent or files for bankruptcy. So in other words, like what it looks like, and you'll know this from my other videos, is that I can't draw too well, but luckily one of the things I can, I guess, draw with some degree of accuracy, we could say, is, let's just get rid of this. There we go. Let's look at this. Let's look at this trust, and let's just pop it right down here. Here's our trust agreement. Always there's going to be three parties to the trust, right? So we have the grantor, we have our trustee or our trustees. And in this case, our beneficiaries are going to be two parties. So we got party number one. Let's just call this the executive or the employee, whatever. And our second party, very important, are going to be the creditors of the employer. Okay, so these are the two parties here. And so tax-wise, what's happening? Yeah, the employer is, we're dumping money into this trust, and we'll talk about the funding vehicle in just a second. And this money presumably is going to grow. And when we're dumping money into this trust, keep in mind that the money still is the property of the employer. That's why if these guys go out of business or if there's insolvency, their creditor lines up with the executive. What does that tell us? Go back to our three income tax doctrines that in other videos I mentioned that we absolutely have to know. Substantial risk of forfeiture, which that exists here. Why? Because if these guys go belly up, if they're become insolvent, guess who the executive has to fight it out with to get the money in this trust? With the creditors. So there's a substantial risk of forfeiture. Okay, at that time, there's no economic benefit, and there's no, I'm just going to shorten it here to constructive receipt. Three income tax doctrines that I have another video for you guys to review and brush up on. Oh, okay. So that's why when this grantor is dumping money into this trust every single year or whenever, it's because there's a substantial risk of forfeiture, because these guys can become insolvent, because these guys, if they become insolvent, the creditors are going to line up their attorneys as well to go after this money, that there's a substantial risk of forfeiture. So no taxation at that time for the executive when it's being funded, no tax deduction for the grantor, because this guy over here has not been taxed yet. Okay, but if there's a change of management, a change of heart, a change of control, whatever, then the trust terminates, it pays out to the executive. Okay. Now, because these assets here are still considered the property of the employer, if the assets in this trust are generating income, which we hope are, or gains or what have you, these guys, the company, the grantor, let's call it company / grantor, is going to be taxed. And what happens with trust rates, they're the same as income tax rates, but we happen to hit the highest income tax rate, which is close to 40%. When the trust income here gets to be about, I'd have to double check the figure, but it's around 13,500 or right under 14,000. When the income generated or the gains generated here reach about 14,000, that trust income, which is going to be distributed ordinarily to the company, or if it's not, if the income is retained in here, it'll be taxed at a ridiculously high rate at a ridiculously low gain amount. Again, once about 13,500, 13,750, somewhere in that range. Okay, so then what do we typically fund the benefit here with? We're going to have a life insurance policy, because a life insurance policy, which I have another video on the very numerous facets of life insurance. The life insurance policy allows, cash value policy provides for tax deferred growth. The other nice thing about it is that when this guy walks away, let's say he doesn't die, but he just walks away at age 55 or 60, the cash value in here has continuously, hopefully, compounded with dividends and interest and so on. And this can just be distributed to the executive, and maybe there's, I don't know, maybe there's $1 million of cash value in there after 20 years of being with the company. Okay, but if this guy dies, it becomes, disabled, and we can have different types of policies. But let's say this guy dies, and then what we have is the life insurance policy pays out to the trust here. Trust, and the company turns around, pays that death benefit to the executive's estate. Okay, so let's run over and see if I missed any points here, but the employee benefit is not protected if the employer becomes bankrupt or insolvent. That's the key to the special tax feature here, because there's a substantial risk of forfeiture that the executive has no taxation when the employer is contributing to the trust. Okay, the assets in the trust can be reached by the creditors over here. The employee has a substantial risk of forfeiture, no income taxation as mentioned. The trust assets are actually the property of the company until there is some triggering event that's spelled out in the trust document here. So it could be due to death, disability, the guy retires, he's terminated, whatever. Okay. When the benefit is actually paid, that's when the executive is going to recognize the income that's distributed here. At the same time, the employer gets a tax deduction for all those contributions and the benefit being paid out. And I'll double check this figure. I think I put in 13,050 for some reason. I seem to remember this is 13,500. It very well could be, but just make sure that you brush up on that. And we have that absolutely correct. Okay, so those are the big things with the Rabbi Trust. Just make sure that that we do have a substantial risk of forfeiture. Make sure that that the trust assets are still the value or are the property of the employer until they're obviously paid out. Make sure that we know we're typically going to fund these with a cash value life insurance policy because of the tax deferred growth and the guarantee that comes with that policy. That way the employer doesn't have to worry about too much if the guy dies. We promised them $1 million. How do we come up with that money? You do that right here with the life insurance policy. Okay, so that's our discussion on Rabbi Trusts. If you liked what you heard in this video, make sure you like it. Make sure you subscribe so you get updates as I upload more videos, and to make you aware of other offerings in an attempt to help you pass the CFP board exam. Thanks for tuning in. See you soon.